Lots of FOMO out there, people. We need to step back and look at the bigger picture to get an idea as to where this market may head next. GDP came in hotter than expected at 2.6%. Market didn't do much, but it did finish down on the day. Leading up to Amazon reporting earnings, it was down roughly 20%, which was a 2 sigma move. Holy moly, a 2 sigma move based off of the implied volatility going into earnings. But we got a bounce, and we're only down around 12.8% at the time of this recording. Apple was down and tagged its lower earnings expected move. It went down about 5.5%, but it bounced back and recovered into slightly up on the day. Let's look at some longer term charts. This is the quarterly chart for the S&P 500. Now, if you watch my quarterly chart video where I talked about 2 quarterly closes can lead to some devastation, well, good. If you haven't watched that video, but we've gotten those 2 quarterly closes, and now what are we doing? Well, we're doing right now is back testing the quarterly declining 5-period moving average, which is where it is at 39.09, the important level we've been talking about. We had that bearish crossover on the price percent oscillator too as well. So guess what, ladies and gentlemen? We got wind in our face. No news there. If we take a look at the monthly time frame, S&P 500 ticked to where we said it could go, right? The declining 5-period moving average on the monthly time frame. Where is that at? 3874. You can see right here, we tagged in. It got outside of bear market territory, which is the red shaded area for a day, and then we came back in. This line right over here is the monthly expected move, and you can see we're floating right around in that area. Quarterly expected move is actually could take us to around 4,000, which would be back above the monthly 5 EMA, and that would be a bullish case scenarios that we got to be aware of. If you take a look at the Qs, same situation, right? It came up to the 5 EMA, but it then bounced off a little bit. I want you to also notice here the PMO, okay? So this is the S&P 500, the price percent oscillator. Notice the bearish crossover right here, all right? And what did price do? Okay, it started heading down. What happened to the bullish crossover right here? And then you get this nice wide spread, right? Well, price action started moving obviously higher. Okay, it wasn't up until this point where we started to see distribution, and you can see it started to flatten out and then cross over. Why am I pointing this out? It's because currently, as you see, we have a bearish crossover, we have a wide spread. We haven't even begun to see this flatten out to cross over. It can take some time. So it's not some sort of rush like a lot of people are calling for a blow off top. If it does, this will change and it'll fix itself, and we'll be ready for that because we can look at key levels. But as it stands right now, you got wind at your face from the long perspective. It's just what it is, right? Lower highs and lower lows. That's the trend currently. Once it changes, I'll change my attitude. IWM, we closed just above so far on the monthly expected move, as well as the monthly 5 EMA, which is at 178.45. You can see here we actually have a subtle tiny uptick in the price percent oscillator. We'll see where the month finishes off, and we get some decent volume coming in here too as well. Like I said, this is really just going sideways. You can see we're going sideways right now. So yeah, if we ping pong around, would you be surprised if it goes like this and then right back down? I wouldn't. I mean, that's just trending sideways. We haven't gone anywhere for what? 1, 2, 3, 4, 5, 6 months. Okay. Remember the distribution that we've seen up here went for even longer, and then we started to move down. But the price percent oscillator is still wind at our face. Okay. So this is overall a good note for IWM because it could be building a base. It could be getting ready to fire off, right? That's all positive and all good and gravy. But it hasn't happened yet, right? We're just seeing some relative strength right now. It's doing good for the month to date, right? It's up 8.59%, which is pretty darn good for the IWM. But remember, this is coming off of a month, right, that got far disconnected from the monthly 5 EMA, just like this month, and we snap back, and where do we end up? Well, I mean, we came right back down, all right? That's because the trend is currently bearish as it stands, and we're in bear market territory. Now, if you look at the S&P 500 on the daily time frame, we crossed below this little hammer candle right over here, which indicates that we could see some more further sell side. However, we had, and also to note too, we've had now 2 distribution days back to back, which means we have increased volume on 2 down days. So this basically means that there's a pretty strong chance that this bottom is not actually the real bottom. However, it doesn't mean that we can't see some more moves to the upside. Remember the June bottom. We talked about that, how distribution days were building up, and it took, a couple months, like 1, 2, 3 months of price action just to take out this current low. So it could be very similar situation. We don't know, right? If you see here, where price action, we gap down, basically right here, right? Boom. And then we started moving up, kind of similar like that, where we had some subtle pullbacks. It could be another subtle pullback, could be another rip, right? Remember this big, move down to the downside right here. Everyone's like, oh, it just took out this, right? But then we started to see it move. Oh, it started to sell off. Oh, we started moving up higher, and then we blew off right to the 200-day. So yeah, we can always have consistent rallies. I'll look more into that here on the shorter time frames. If you take a look here on the 15-minute time frame, we are still trading above at least the cash close at that 5-day moving average, and it is inclining. You can see we tagged the upper weekly expected move. Now, I want to really quickly point out what it looks like after hours. Where does it look after hours? Right back at that chop box, which is previous areas of resistance, 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 chop up. Previous areas of resistance may act as a potential area of support. So it's going to be interesting to see how this plays out going into tomorrow's trading session. But as it stands now, it looks like it's going to open below a 5-day moving average, which could mean that the 5-day moving average could very well start declining in the near future if price action wants to continue to trade down that way. Okay, and remember, if it comes back in the chop box, what to expect? Well, we expect more chop. This is a very difficult trading environment. You shouldn't be rushed or pushed like I gotta make a decision right now. No, I just be careful. Okay, now if you take a look at the SPY expected move going into tomorrow, we're expecting roughly, based off of implied volatility, a $5 move in the markets, which can take you to about 385 to the high end, and which is right where it brings us right back to the weekly expected move. Or it could potentially take us as low as 375. That's just based off implied volatility. Remember, we can get to standard deviation moves. We saw that in Amazon today. Okay, I mean, we actually, if you just look right here and you just go back, okay, that's around that 376 marker. Where are we right now? Well, we came right into that area after hours. Okay, so it already tagged, and guess what? We started bouncing from that level. So that expected move was actually hit. So we'll see what it is come tomorrow morning too as well. Okay, so yeah, expect more volatility, right? We can fire right back up to 384. It's going to be heavily dependent on Apple, right? Apple, if it starts catching a monster bid, that'll probably be a good thing for the overall markets because they're highly correlated. Now, if we take a look at a couple indicators, right? We talked about the ratio between bonds and S&P 500 was getting way out of control, moving way up as bond market was completely nosediving. But you can see here, there is a divergence that we've been pointing out that's been building. The last time we've seen divergences like that are the boxes that are highlighted in yellow, right? So you have the ratio up here and you have the S&P 500 down here. And after those ratios were, pointed out, we've seen moves to the downside in the overall market. Are we going to get another push to the downside? Maybe a small one. We'll see. On a good note, the CPC signal actually triggered a buy signal, which means the following day could be a buy, opportunity to buy. Now, it sometimes, right, so we get like these 4-day extra pushes, but this one right over here, I want to just point out a time where it didn't trigger right away. It triggered right here, and you can see we actually had some follow through to the downside, but then it came back up, and then it triggered back again, and then we started to get a big rally. We got another buy signal and a shot off for another 4 days. So it's something interesting that's currently building. This is for the 26th. Okay, so the 27th is today. So this chart has not fully updated yet. Now, from a more bearish perspective, BPSPX chart, same with the NASDAQ charts, we're moving into overextended territory. These are the areas where I say just let your foot off the gas, right? Be careful trading here because it can stay overbought for a while. Yeah, negative divergences can build, but it's not the place where you want to get highly aggressive. Last thing that I want to show you is the NASDAQ composite. I shared this chart a while ago showing this chop box that was forming. It was actually back probably around this range. And what we called was, hey, don't be surprised if we see some rally right back up to this area. Well, we saw a rally right back up to prior resistance, and now we started to sell off. As it stands right now, from a bullish perspective, this could potentially have the opportunity to be building out an inverse head and shoulders. So as long as this low stays intact, and I would say this low too is an important low as well. If this can stay intact, that would be a pretty bullish development, but we would still need, from an overall perspective, this 11,200 to be taken out for the neckline, and it could spark a pretty large rally in the financial markets. That's all I got for you on today's episode, everybody. See y'all later.